This is ACC Amit Kumar, and we'll discuss IS 40 investment property. I've discussed a little bit of it while discussing the previous standards on property, plant and equipment, intangible assets, because this standard is important. Now, this standard is only for land and building. When we look at investment property, we will think that investments are shares, investments are in the form of machines, but this standard is only applicable, IS 40 is only applicable to land and buildings. This was specially introduced because land and buildings, their appreciation value is different from what they are recorded, and they are existing in the business for the last 50 years or 30 years, but still the business is recording them at historical cost. If we plan to invest in these land and buildings and we are not consuming into the business, what category we should assign it? So there was a confusion among accountants, or for the purpose of fair presentation, it was suggested that these land and buildings should be forming part of investment properties because you are holding them for capital appreciation or for renting it out to others. Now, from consultant's point of view, what we need to identify, we need to be careful about how that land and building is being used by the business. If the employees of the business are owning that property, if it is being used as a head office, or they are using it for commercial purpose, for their own purpose, they are consuming that land and building. It may also happen that the building has 4 floors and 2 of the floors are being used by the business themselves and 2 of them are rented out. Now, renting is not their primary business. Since renting is not their primary business, this land and building is held for capital appreciation and for renting it out to others. The other 2 floors will be forming part of investment property. The 2 floors which are being consumed by the business will be forming part of property, plant and equipment. So the analysis will be in bifurcating whether we are holding it for capital appreciation and renting it out to others, or whether we are consuming into the business. If we're consuming it into the business, we'll be charging normal depreciation on the building, though land is not depreciated, and we'll continue to record it on cost model. IS 40, some of them were of the opinion that it should be at fair value, but some of them were against it, that we do not wish to go to fair value model. So IS 40 was introduced with the purpose of introducing fair value model, not to introduce cost model. This cost model is already existing in property, plant and equipment. By simply giving one note, the purpose could have been sorted that among the property, plant and equipment, the ones which we have identified separately or have disclosed in the note separately, that these are properties we are holding for capital appreciation or for renting it out to others. But this doesn't give a clear communication, so IS 40 was introduced, and the main purpose was to introduce fair value model. But that purpose is defined. Like if you notice, in India we have only one model. So there were 2 models, cost model and fair value model. If someone is following cost model, they'll have to follow the principles of IS 16 property, plant and equipment, which means that they do not have to repeat what cost model is, how it is going to be depreciated, and how it is to be recorded either at historical cost or net book value. That's the choice. The manner of presentation. So the cost model accounting remains the same, so there is no change. If you are using the same cost model under IS 40, the accounting remains the same. We simply need to follow the principles as used in IS 16 property, plant and equipment. Now you can make out that since ISB wanted to introduce fair value model, they had to introduce this standard because this is already in line with the previous standard. There was no need for new standard. The new standard is being introduced just to highlight that the property means land and building here, can be recorded at fair value. And when we record at fair value, we need to measure it at fair value, and we need to remeasure it on each reporting date. Reporting date here, I mean balance sheet date, or whenever you're publishing your annual financial statements, you need to remeasure it. Now, where are the complications? Now, since it is at fair value model, if it is at fair value model, there may be changes in the use of property. So we'll be looking at the changes in use of property. If the property is at cost model, it changes the use to IS 16 property, plant and equipment, there will not be much of a change. But if the property is at fair value model and our accounting policy for IS 16 property, plant and equipment is cost model, then the fair value becomes the cost for that property. So we'll look at the transfers in detail, but for time being, I just wish to give you an overview that these are the complications which we may encounter when we are dealing with IAS 40 investment properties. Mainly, this is applicable to only land and building held for capital appreciation and renting it out to others. If your primary business is of renting, like you had been into some other business and suddenly you have decided to start your own renting business, in that scenario, the property will shift from investment property to your inventories or will be forming part of your PPE because you are using that property for consuming into the business. If you are in the sale of properties, then it will shift from IS 40 to inventories. So we have to be very careful in identifying what the asset is, what is the purpose for buying it, how we plan to use it. Depending on it, our accounting follows. Is the reason I discussed all these standards together so that we can differentiate between them, and that's where your consulting expertise will be required. That you'll be given a scenario wherein there will be many attributes of a property and you need to clearly identify which standard is applicable and why it is applicable. That's where our role is. Another thing which they did was that if someone is using cost model, they'll be following the principles of IS 16, but they need to disclose it in notes to accounts. Disclose the property in notes to accounts, which happened with IndAS 40. Now in India, it's a very interesting one that we do not have fair value model in India. We have only cost model. But by chance, we have maintained that the fair value of the property should be disclosed in notes to account. This we are maintaining. We are using the cost model of the property, but we are maintaining that if you are using cost model, the fair value of the property should be disclosed, which was a difficult task for some of the entities, and they were asking that since we are not moving to fair value model and we are only using cost model, shall we get into this exercise of fair valuing the property, which again demanded for costing from a valuer perspective. The valuer will demand some money for valuing this property, and this will be required at the end of each year. So this is an additional compliance cost which has been added, even though we have not taken IndAS 40 fair value model, but still IndAS 40 contains only one model, cost model, but the company could not avoid the compliance cost of fair valuing the property, which we still need to disclose in the notes to accounts. So the only difference is we are not showing it on the face of the balance sheet and we are not remeasuring it at the end of each year. So the entity could avoid the P&L by not transferring the difference into P&L at the end of each year. But for the purpose of disclosure, for fairer presentation, for shareholders to know that this property is worth this value, at least is being disclosed under IndAS 40. Any questions till now? Hello? Any questions till now? Isn't it interesting like this? How the standards have been developed and what has been kept in mind. So when we are moving to a new standard, it's not just the fairer presentation, it's also the compliance cost, which has been debated, like that if we move into this standard, if we choose one choice over another, there is a compliance cost related to it as well. Like cost model is easier to comply than revaluation model. Cost model is easier to comply than fair value model. The fair value model and revaluation model demands for extra additional cost. Recruiting a valuer who will value it, we need that person at the end of every year, so that's an additional cost to the firm, which they may not wish to get into. But if it plans to take a loan, they're already highly geared company and they wish to get more loan, I think that's the point which triggers, which gives them more benefit than the cost of a valuer, that they would like to go on to revaluation model. But the catch is, once they move on to a fair value model or a revaluation model, they cannot come back. So in IS 40 investment property, if investment property we have been valuing at cost model, and if we decide to change the model to fair value model, there is no chance to go back because we'll never be able to prove that cost model gives fair representation. So these are the catches we need to follow. IS 16 property plant and equipment, once a company moves from cost model to revaluation model, they cannot come back. Investment property, once a company moves from cost model to fair value model, they cannot come back. They'll have to follow it consistently thereafter because they'll never be able to prove that it gives fairer presentation. So investment property is land and building or both. So the word property contains both land and building held by owner or a lessee under a finance lease. If someone is owning it, even under a finance lease, if someone is owning it, but they are holding it for capital appreciation and for renting it out to others, they bought it under a finance lease, they did not pay the money outrightly, they have financed it themselves, but their purpose is to hold it for capital appreciation, they're paying money in installments, they can show it as part of the investment properties. The purpose is to earn rentals or for capital appreciation or for both. That's the main purpose of investment property. This standard, there's one line I'll discuss. Investment property does not include property held for use in production or supply of goods or services. Which property is this? Which property is this which we use in production or supply of goods and services? IS 16 property plant and equipment. For administrative purpose, IS 16 property plant and equipment. For sale in the ordinary course of business, this is inventories. IS 2. So examples of investment property are land held for long-term capital appreciation rather than for short-term. If we are holding it for short-term sale, that is IS 2 inventories. Land held for currently undetermined future use, that you bought a land and there is no purpose for buying that land. The management has not decided the use yet. So if there is anything such, any land or building for which the purpose is not defined, that will automatically be shown under investment properties that we must have purchased for capital appreciation or for renting it out to others. A building owned by reporting entity or held under a finance lease and leased out under operating leases. What does this mean? That they're holding it through a finance lease, means they're owners of that property, but they're renting it out to others. Their primary business is not of renting, but still they have rented out their property on operating lease to someone. It can still be classified as an investment property because that's your main motive. A building that is vacant but is held to be leased out. So your primary business is not of leasing, but you're holding any property which is vacant, but you plan to lease it out. It will be considered as an investment property. Property that is being constructed or developed for future use as an investment property. If something is being developed or constructed for future use as an investment property, but till the time it is developed, we need to follow the principles of IS 16 property, plant and equipment, self-constructed assets, because we need to add all the costs which are required to make that property. So we'll follow the principles of IS 16 till the property is ready for use or sale. The moment it is ready, it can be transferred to investment property at the cost at which it is constructed. But the costing principles are governed by IS 16 property, plant and equipment because they do not wish to repeat what all costs should be included, what all should be excluded, how it is going to be valued, how the self-constructed assets is going to be valued. All the guidance is given in IS 16 property, plant and equipment. Since they are not repeating it in IS 40, we will simply follow the principles of IS 16 till the asset is ready. Any questions in this? Any questions in any of the example? Hello. If it is clear, you can just give a buzz to me in the chat. I stopped because there may be some confusion in any of the example to understand, so I thought to ask you.
Yeah, Amit, can you please come over to that again, that the building is under construction and until the is prepared?
Suppose you are constructing a property and your intention is to use it for capital appreciation and for renting it out to others in future. That you're constructing it as an investment property. But the period during which it is being constructed, IS 40 has no guidance how you will add the cost. What all cost you will include as part of your direct material, direct labor, direct expenses, what all cost you can include as borrowing cost. That when you are self-constructing an asset, there is a guidance in IS 16 property, plant and equipment, what all cost you can include as part of cost of making that asset or self-constructing an asset. when you will test for impairment. All this guidance is given in IAS 16. So IAS 40 doesn't have any such guidance. This is the reason till the time it is being constructed, we follow the principles of IAS 16. The moment it is ready, so from day one we are making some property which we are going to use as an investment property. From day one there is no mechanism wherein we can include it as part of our IAS 16 property plant and equipment, because there is only IAS 40 investment property. There is only two models, that is cost model and fair value model. So they have not repeated the guidance. That's what I meant. The guidance of how to include or what not to include, what to exclude, what all can form part of components of cost of a property is guided by IAS 16. Yeah.
Okay, thank you.
They're not repeating the. So it happens that like it happened for cost model as well. If you're following cost model of IAS 40, you need to follow the principles of IAS 16 to charge depreciation to record. So they did not repeat, since this is an additional standard to give clarity on your property. Because if they would have repeated, that would have been cumbersome. Like, so simply they refer to IAS 16 for charging depreciation, refer to IAS 16 for building up the cost of an asset. Clear?
Yeah, thank you very much.
Any other doubt? Leases component is clear? Leases this is from the lessor's perspective. We are a lessor. We have bought a property on finance lease, and now whatever we do, now we can consume it into the business, we can rent it out to others. If our primary business is not of renting, then if we are renting it out, that means that also, even if we have given it on renting as an operating lease, that can still form part of our investment property in our books, though we have taken it on finance lease. That is a classification of asset. Investment property excludes property intended for sale in the ordinary course of business. Which property is this?
This is held for sale.
Property intended for sale in the ordinary course of business.
Then this is IAS to inventory.
This will be IAS to inventories. Property being constructed for third parties. This used to be earlier IAS 11 construction contracts, but since April 2018, this is now IFRS 15 revenue from contracts with customers, because all those standards of construction, revenue, barter transactions, customer loyalty programs, transfer of assets from customers, all those guidances, all those standards has been merged together. I did share with you what all standards have been merged under IFRS 15 in the first session, and how they are withdrawn or how they get merged into another standard. So property being constructed for third parties, there is a separate standard, that is IFRS 15. We cannot. This is being done on contract basis. Owner occupied property, that is IAS 16 property plant and equipment. A property classified as investment property may be owned property, may be property held under a finance lease. Property leased out by lessor under finance lease, under operating lease. If someone has given it out on finance lease to someone, the other party has taken it on finance lease, that means the property has been sold indirectly by the lessor. If it is sold indirectly by the lessor, it is no more part of the investment property. It is no more even part of the books. But if they are holding a property which they have given it out on rent, they can continue to show it as part of investment property. I'll clarify this, one second. There's a lessee, there's a lessor. Lessor is holding a property, land and building, and they give it away on finance lease to someone, to lessee. If they give it away on finance lease, lessee becomes the owner. Lessee is the owner of the property now, and they have to de-recognize the asset. Agree or not? When we'll discuss this, now this concept remains the same for lessor, but for lessee accounting has changed. There is IFRS 16 which only talks in terms of right of use. I'll not get into this now, I'll discuss it in detail. So the lessee accounting has changed in the form of IFRS 16. So there was a lot of confusion in this area, wherein when a property was being leased out to a third party, whether they become owner or not, how much right they have, and they used to be leased back as well. So all that confusion and also elimination of uncertainty between whether we should recognize it at finance lease or operating lease has been removed by one word today, right of use. This is just for information as of now. I'll discuss it in detail when I'm discussing IFRS 16. I'm just using this word for information only, simply because I know that this is going to come to your mind when the moment I say the word leases, there will be someone who will think that it has changed. Why we are discussing the previous one? The previous one I'm discussing simply for the sake of IAS 40, that if there is a lessor who has given out their property on finance lease to someone, the property is no more with them, they'll not show it as part of the investment property. But if they are holding, if the lessee is owning a property through finance lease. If they're owning a property through finance lease, some lessor has given them this lessee who's owning the property, if they further give it on operating lease, this lessee has the option to classify the investment property, classify the property as investment property. If I give it in terms of name, that alpha is the lessee, is owning a property through finance lease from beta. Beta is the lessor in this case, and they give it further on operating lease to a third party. They further give it on operating lease to gamma. This can happen, that one party, alpha, can purchase a property on finance lease. Purchasing a property on finance lease indirectly means that alpha didn't have money, but alpha is ambitious enough to get into a finance lease wherein they are saying that we'll be able to pay capital repayment, we'll also be paying interest, and I wish to become the owner of the property even though I don't have money. So alpha gets into this arrangement and becomes an owner of a property. Now when they become owner of a property, they can give it further on operating lease. And if they give it further on operating lease, they have a choice. They can classify it as an investment property. Is this clear?
Amit, just one question here.
Yes.
What's the difference of the first situation where lessee is the owner of the property and the second situation? In both the cases, lessee is the owner, even if he is going through finance lease.
So this is step one. I said if lessor gives away the property, then lessor is no more the owner. So this is example one, wherein lessor doesn't remain the owner. So this is, suppose Paul sells the property to Alpha, or you can say I'll use the beta. Beta sells the property to alpha. So I was talking from beta's perspective that beta is no more the owner now. If beta is holding something and they give it on finance lease, beta has given it on finance lease, alpha has taken it on finance lease. Now alpha is the owner of the property. Now, beta cannot show anything as part of their books. So this, the first example was in relation to beta, that beta will have to de-recognize the property from their books. It will not be forming part of their books. The property is with now alpha. Alpha is the owner through a finance lease with beta, but they have a right to give it on rent to others as well, because since they are owners now. So what will happen in alpha's books, I'm talking about that alpha can show this as part of their investment property.
Okay, perfect. You also mentioned that Alpha has an option to classify the property as an investment property. What all other options he has? It's only one category or another category
The other
also?
option is that if he's into the business of renting, then he'll have to show it as part of its property, plant and equipment.
Okay.
But if his business is something else and he is entering into this one-off arrangement wherein he's owning a property and renting it out, then he'll have to show it as an investment property.
Okay, perfect. Sorry to ask you one more question. What is the difference between finance lease and operating lease?
Finance lease is when, in a layman's language, finance lease is when I don't have money, but I still wish to, I'm ambitious enough to own the property by paying principal repayment and interest, and enter into a finance lease with the party saying that I'll pay you in future, but you need to give me the asset today. So I become an owner of the asset today, but as well as I also become liable to pay today. So in my balance sheet, there will be two line items. One will be an asset and one will be a liability of the same amount, because I didn't pay any money today. If I pay some money, then the liability reduces by that amount. So this is for highly ambitious people, finance lease. Operating lease is, I believe that I'll not be able to meet the capital expenses. I'm able to pay rent. So I'll go out to someone and say that give me this asset on rent. I am capable enough to pay monthly rent to you, or for rent for 1 year. Okay, it's about ambition,
Okay, got it.
or you can say the stage of the company. I have related it to ambition or the stage of the entity or the risk one can take. If someone gets into an operating lease, the risk is only of the monthly rent or the annual rent. But if someone gets into a finance lease, they not only have to bear the interest component, but also need to make capital repayment for continuing to remain the owner of the property. It's a stage. It's a stage in the life of a company. That's what I would call.
Got it, got it.
Nowadays, the concept in case of lessee. Now, since I have reached that point wherein everyone is at par now, that since I've discussed the difference between finance and operating. In case of lessee, there was a lot of confusion whether they should be finance lease or they should be operating lease. Uday, you were saying that includes office long-term rentals. Yes, if we are owning any property which we have taken on rent for office use, that will be considered as an operating lease for us. But today, this concept is going away. IFRS 16 leases, there were two parties, one was lessee and lessor. Lesser accounting, there is no change. They'll continue to differentiate between operating lease and finance lease. Operating lease means they have, so I'll write beta is a lesser and alpha is the lessee. Only lessee accounting has changed. There is no change in lesser accounting. Lesser accounting, beta's accounting will not change. If they have given away the property for use, they will show it as part of their operating lease. If they have bought a property on lease, that will be forming part of their finance lease. Operating lease means they're owning a property today and they are giving it out on rent. They'll say that we have given out the property on operating lease. They wish to become owner of a property. They record it as part of their finance lease, that we are owning this property through making payment in installments in terms of capital payment as well as interest repayment. This is the lesser. There is no change in lesser accounting as far as IFRS 16 is concerned. There is no change. The only area which has changed is lessee accounting. Lessee accounting, there was a lot of confusion whether they should record it at operating or finance. Now, no more classification. No more classification in terms of operating or finance. There's only one word now. It is known as rights, right of use. This is being recorded. Now there will be confusion in your mind whether it is an intangible asset. So this looks like an intangible asset, but IAS 38 intangible asset doesn't own it as of today in the form of term. They do not show any relationship, but this is kind of an intangible asset being recorded in the books, but this is coming in from IFRS 16 leases. So we'll not say that it is, because when you're reading IFRS, you'll feel that we cannot touch it, we cannot see it, but since this is an agreement which is giving us economic benefits, so shall we classify it as an intangible asset? As of today, ISB has not made any relationship between IAS 38 and IFRS 16. They could have done so, but that could have created a lot of confusion. So it's better to amend IFRS 16 and coin a new term, right of use. This is a new term being used only for the purpose of IFRS 16, right of use. Now they'll be recording, they'll not be recording any operating or finance classification. They'll be simply recording if one party has given a machine on rent and the useful life is 5 years and the value is 200,000, if it is given on lease to them for 3 years, they'll record right of use of the property for 3 years. They'll record that asset 200,000 divided by 5 into 3. That we have owned this asset. This right of use may not be directly 120, but I'm just giving an example that a portion of 200,000 will be consumed by the lessee now. A portion of the value of 200,000 is going to be consumed by the lessee, and that portion they'll be showing as part of their asset side in the form of right of use. No more classification in terms of operating and finance. I wish to get into detail of this standard when I discuss IFRS 16 so that I can discuss everything and 10 of it. For the time being, simply giving information. Hope this is clear.
Yeah, Amit, I have one question is just popping into my mind. This is regarding that. So for the lessee's perspective, everything is finance lease now, right? It is.
No. From lesser's perspective, it is same. Whatever we used to classify.
From lesser's perspective, it is operating and finance both.
Yes.
But from lesser's perspective, it's only the finance lease.
Only right of use. No finance. Yeah, you are right in one way. That finance lease, the asset was on the balance sheet. There was equity recorded on the balance sheet.
Yeah.
So in case of lessee, operating lease was off balance sheet item. Why it happened? Do you know this? Why it happened? This was an off balance sheet. Operating lease was an off balance sheet item, means it was simply off balance sheet item. This was on balance sheet item. Finance lease was on balance sheet, means it was coming in the form of asset as well as in the form of liability on the balance sheet. Operating lease was nowhere coming on the balance sheet. It was being treated as a rental expense, was being shown as part of P&L and was getting deducted from your P&L every year and was reducing your retained earnings every year off balance sheet. So some of the aeroplane industry was using it for their benefit. One party was selling the aeroplane. They were saying that we have sold the aeroplane on finance lease. When they finance lease sold, according to them, they were selling or they were selling in the form of revenue. They were recording as sales. Lessor was recording the sale of an aeroplane as sales, But they were saying that no, we have not taken it on, we have not bought it in the form of sale, we have taken it on rent. We'll be paying rental expense to them. And there was some installment arrangement with them in the revenue arrangement. There was some installment arrangement that the party which is buying this aeroplane, since it is a costly affair, will be paying in installment. The buying party was considering it not as a finance lease, but was considering it through some loopholes in the standard, that they are actually paying rental expense for owning that or for using that aircraft. So they were knocking it out of their balance sheet by reducing their inventories that the aeroplane has been sold. They were recording hefty revenue that we have been successful in selling an aeroplane. They have been avoiding their gearing levels by not bringing that aeroplane onto the balance sheet, by avoiding it. This was a big loophole. The aeroplane was in the air. So is the reason the accounting was changed. So this, it doesn't matter to them much, but it matters a lot to lessee accounting if the aeroplane is not recorded onto the balance sheet. And there's a huge liability as well. They were able to avoid huge liability. They were able to avoid the return on investment because they were not showing it as part of the capital employed into the business. So this has been rectified with the introduction of IFRS 16 leases, that no matter what the arrangement is with the lessor, whether lessor records it as their operating or finance, no matter what they do, you have to record it as an on balance sheet item now, no concept of off balance sheet. Whatever your situation, you have to bring it onto the balance sheet. Now this right of use is consisting of your any direct expenses, any present value of minimum lease payments you have agreed to pay, whatever payments, or if there is any cash paid to get it. So what all these components will be forming the right of use asset. That this has been paid to own this asset. We are paid in the form of direct expenses. We are committed to pay some lease payments over time. We have paid some cash today. Whatever they have paid, the total money will be forming part of their asset, right of use, and what they are liable to pay will be also forming part of their liability. Liability will be their present value of minimum lease payments. Earlier, the amount of finance lease and liability was equal, but today it may not necessarily be equal because you may have paid something in cash. You may have paid for your direct expenses. So what you are still liable to pay will be forming part of your liabilities. So this is a big change in terms of IFRS 16 leases. Banu, hope it is clear now, like since you did. I've summarized that.
Yeah, that is clear to me. Thank you. My question was that, say, for example, there is a builder which is selling apartments, and there is a lease agreement between the buyer and the seller. Is that the lease is for, say, for 99 years, and it is for the apartment, but after the expected life of the apartment or the building is say 60 years, but the lease is for 99 years generally. So what happens? What sort of the lease it would be, either finance or operating, when after 60 years there will be no apartment there, but the land still belongs to the builder.
So land is land is going to be for a foreseeable period. Land is from a lessor's perspective, land will always be an operating lease. Because land is going to get returned to them after a certain period of time. So we always have to bifurcate land and building into two components. Building may be on finance lease from lessor's perspective, but land will, in most of the cases, land will be operating lease if it comes back to the owner. If it doesn't come back to the owner, it can be finance lease. But if it comes back to the owner, no matter what the period of the lease, it may be 250 years. After 250 years, if it is going to come back to the owner, it is still an operating lease because land is for a foreseeable period. Land continues to exist forever. So we'll bifurcate it into two components. From lessor's perspective, land will be operating, building will be finance. But from lessee's perspective, it is only right of use. Then land and building gets clubbed for them for whatever period they are able to use it. Now, in case of lessee, it is for 60 years. Lessee will use the land for 60 years, will use the building for 60 years. So land and building can be clubbed from lessee's perspective, and for they will only show a right of use in their books, that they are going to use this land and building for a period of 60 years, and they'll depreciate it over a period of 60 years. Clear?
Yeah, and then there will be nothing left with the lessee after 60 years.
Yes. Lessee will have nothing after 60 years. So land gets back to the owner after 60 years.
Right. It's clear. Thank you.
Yeah. So it's good that we're getting into so much detail, so there will not be any confusion left as far as classification of assets are concerned. And your leases is also getting clear. Now my life will be easier when I'm actually discussing IFRS 16 leases. When to recognize investment property? When you believe that you're going to earn economic benefits out of it and you can reliably measure it. This is the principle of an asset being used everywhere. Cost includes transaction costs, cost of purchase, or any cost which is required to bring the property to its present location condition. Example, professional fees for legal services, property transfer taxes, anything which is directly related. Without it, we cannot use the property. We need to include it. Two options: fair value model, cost model. If we're using fair value model, we need to measure all the investment properties at fair value. We cannot say that we are using 5 properties at fair value, 5 properties at cost. If your policy is to use fair value model, you need to apply that policy to all the investment properties you're holding. The gain or loss arising at the end of each year will be charged to P&L or credited to P&L. Fair value, now we have IFRS 13 fair value measurement. Will have 3 levels of fair value, which I discussed. I'll again discuss it when I'm discussing IFRS 13. I'll not get into it now, but I discussed with you 3 levels of fair value: level 1, quoted market; level 2, similar unquoted market; level 3, observable price. A lot of disclosures are required when we are using level 3. So we use independent professional valuation, obtain recent price of similar properties, obtain value using discounted cash flows. This is the level 3 pricing, and current prices in the active market. This is the level 1 quoted market. We can use any of them to arrive at the fair value, because as I said, fair value is market value is fair value, but fair value is not necessarily market value. It can be observed price as well. If you're using cost model, we'll use the same principles of IAS 16 property, plant and equipment, less depreciation, less any impairment loss. But if you're using fair value model, there is no requirement for impairment, because automatically impairment testing is being done when we are remeasuring the property at the end of last year, at the end of this year. Any difference we are taking to P&L, we are automatically testing it for impairment. We can change the method from cost model to fair value model only if we believe it gives fairer presentation and we wish to move to this fairer presentation. But once you move, you cannot come back. That you need to be careful. So this is important. Transfers. So as I said, transfers to and from investment property should be made when and only there is a change in use. Now it can happen that investment property which you are holding for capital appreciation, you wish to use it into the business. You wish to sell in the ordinary course of business. Or there is an inventory which you plan to sell in the ordinary course of business, you wish to hold it for capital appreciation, or you wish to consume. So for a transfer from investment property to owner occupied property, what will happen? If you are holding something at cost model, it goes back to cost model, there will not be any change. The only classification will be on the heading, that it is no more investment property, it is now PP. Development with a view to resale. For a transfer from investment property to inventories. So you were developing an investment property and your intention was to sell in the ordinary course of business. So if you have recorded it as investment property, at what price you are going to take it to inventories? Inventories are recorded at lower of cost or NRV. So whatever is the cost of investment property becomes the cost where inventories, and inventories are required to be remeasured at lower of cost or NRV at the end of each year anyway. I'll show you the chart how it happens. End of owner occupation for transfer from owner occupied property to investment property. So it will be reclassified. If it is moving from cost model to cost model, there is no change. But if it is moving from cost model to fair value model, if you remember our discussion on IFRS 5 non-current asset held for sale, if we are revaluing it for the first time, there is a revaluation surplus. Thereafter, it moves as investment property. The new fair value becomes the new value. So as I said in IFRS 5, no man's land, measure on existing measurement basis. If we are arriving it at fair value, there is no concept of revaluation model in IAS 40. The revaluation model concept remains with IAS 16. So if we revalue a property, The principles of IAS 16 will apply to it. But once it moves to IAS 40, there is no concept of revaluation model. Then we'll remeasure it at the end of each year, take the difference to P&L. Commencement of an operating lease to another party for a transfer from inventories to investment property. So it will no more be forming part of inventories. We'll show it as investment property and we'll show it as rental income. But how to record these transfers? Have a look. Investment property, transfer to inventory. So whatever is the fair value on the date of transfer, we record it as part of P&L, and the standard after transfer, IAS before transfer was 40, after transfer it becomes IAS 2. So the carrying value of the investment property on the date of transfer becomes the value of the inventories on the date of transfer. Inventory transfer to investment property. So whatever is the fair value on the date of transfer of inventory becomes the fair value, and any difference is taken to P&L. So this fair value becomes the new value under IAS 40. Investment property transfer to IAS 16. So we take the difference to P&L, and whatever is the value or fair value on the date of transfer becomes the fair value of IAS 16 property, plant and equipment on that particular day. Thereafter, we may continue to use the cost model or fair value, cost model, revaluation model, whatever is the model applicable under IAS 16. But at what value it gets transferred? Owner occupied property, this I was discussing, this is coming in from, this is similar to what we discussed in IFRS 5 non-current assets held for sale, that if it is a owner occupied property and we are transferring it to investment property, if you are valuing it at fair value, if you are valuing it at fair value means we are using the revaluation model of IAS 16 property, plant and equipment. If we are using the revaluation model, the difference in fair value and carrying value will be recorded as revaluation surplus, or if there is a loss, we'll be charging it to P&L. Now, it was IAS 16 property, plant and equipment. IAS 16 property, plant and equipment, we are transferring it to investment property. Now, before it gets transferred, if you are measuring it on existing measurement basis, we need to follow the principles of IAS 16 property, plant and equipment, like we did for IFRS 5 non-current assets held for sale, that on the date of classification, measure it on existing measurement basis. It didn't impact them, investment property inventories, it didn't impact them, so they were already at their fair value or cost. But it will impact an owner occupied property because there is only cost model or revaluation model, whichever model there is. And if you're transferring the property to fair value, if owner occupied property is transferred to cost model, there will not be any change. No problem. Owner occupied property under IAS 16 property, plant and equipment using cost model, transferred to IAS 40 cost model, there is no change, no difference. But owner occupied property transferred to investment property at fair value model, there is bound to be a change in terms of, if we are changing the owner occupied property which was a cost model and we are remeasuring it at fair value for the purpose of transfer, the remeasurement for the purpose of transfer will be considered as applying revaluation model, or if we are already using revaluation model, we need to revalue it again. So the difference will be treated as part of our revaluation model, not under IAS 40. The moment this is done, whatever is the value at which we are going to transfer becomes the value under IAS 40, and thereafter it will be remeasured at fair value each year. I'll show it. IAS 16 PP, IAS 40 investment property. If something is under IAS 16 property, plant and equipment, which is at cost model, if I say that I wish to transfer the use of this property, I wish to use it as an investment property, I simply have to use the same cost under investment property. The only bifurcation will be in the heading to tell the investors that we are using it as part of capital appreciation and for renting it out to others. We are no more consuming that property. Classifying it under investment property means that we are no more using it as part of the business. We plan to hold it for capital appreciation or for renting it out to others. That's what classification does. But the measurement is same, cost model, cost model. If it was cost model, but under investment property, we used to use fair value model. Now, if you fair value under IAS 16, if you fair value under IAS 16, it means the model is being changed to revaluation model. So if the model is being changed to revaluation model and the revaluation is done at fair value, revaluation is done at fair value, but the accounting will be done under IAS 16 property, plant and equipment. Whatever is the change in value will be recorded. If it is an increase in value, will be recorded under revaluation surplus. If there is a fall in value, will be charged to P&L. But once that revaluation exercise is done, this fair value becomes the fair value under IAS 40. As done under IAS 16 fair value exercise before transfer. If it was already a revaluation model, and you had to transfer it to fair value, even then the remeasurement would have been remeasured on existing measurement basis, and whatever the new value, the fair value is the revalued amount. On the date of classification. Hope you got it. That what it is. If it is cost model, there is no change. But if it is cost model, we wish to move it to fair value model, we have to consider that it is actually a change in method, and we have to treat the revaluation surplus or charges to P&L. If it is already a revaluation model, we need to revalue again. And that value becomes the fair value. That becomes the basis for IAS 40. Is this clear? Hello? Is this clear? Always remember the IFRS 5 non-current asset held for sale classification. And one more line to remember, if we measure something at fair value, we have no chance of coming back. If we measure something at fair value or some better presentation, we have no chance of coming back to it. So here, if we are moving the model from cost model to fair value model, we have to use revaluation. There's no chance, there's no way we can avoid. So that's the only way, because revaluation is done at fair value, and we need fair value to record it under investment property. Any doubt, anyone? So I know that when I'm speaking through this doesn't get into the head. Is the reason I thought to clarify it, how the movement will happen. I'm pretty sure I'm successful. If still there is any doubt, you can ask.
Yeah, Amit, I have a question.
Yes, please.
Pankaj. Yeah, so Amit, so in not in this one, but earlier one, like if the person has the lessee, the person who has taken the asset on finance lease, and he sublets his asset under operating lease. So now this will be an investment for him. So he would not be recording asset in his books. But similarly, the person who has given his asset to that particular person under finance lease, he also has deregistered his asset under his books. So, so in that particular case, I think the asset has not been recorded in anyone's books. So, like, who would be claiming depreciation for that?
Can you repeat it? Like,
yeah, I said that there was an option you mentioned, that this one, yeah, row number this one, the upside one, where beta has given his asset to other person under investment.
That's what I meant. That this was happening earlier. This has been removed by introduction of IFRS 16 now.
Okay.
This loophole has been removed by IFRS 16. That now whosoever is owning any asset. There is no classification in terms of finance and operating for lessee. No classification. The only word they'll be mentioning in the balance sheet will be right of use.
Okay.
This
So
has gone.
yeah, then who would record the asset in the books?
Both the parties.
Both the parties. Okay.
Both the parties.
Ah,
So
okay, got
I
it.
had an example for it that suppose there's a bottle of water and you are the owner of the water bottle. You spent 20 bucks on it. But if I drink half of it, who is the real beneficiary?
Yeah, the other one would drink it. Yeah.
Who drank it?
Yeah.
So half of it you're going to drink, half of it I'm going to drink.
Yeah.
I'll record half of it in my balance sheet, you'll record half of it in your balance sheet.
Okay. Got it.
Yeah. Because you are going to get the right, I got the right of use, so I may pay you 10 bucks.
Yeah.
Or maybe you may demand more because water is scarce. You may demand more, you may sell it at a higher price to me, that I'll demand 12 rupees from you. So I'll say that I paid 12 and out of 12 I may pay you 3 now, and I'll say 9 I'll pay you in future. So I'll record the asset right of use at 12. 3 I'll say cash payment.
Yeah.
3 I'll say cash payment and maybe 1 rupee direct expense for it. And 8 I'll say will be paying you in future. That will become the present value of minimum these payments.
Okay.
I'll discount this 8 to present value today. Will not record it directly.
Yeah. Yeah.
I'll discount this 8 to present value today, and that 8 will also form part of my liability.
Okay.
Clear?
Got it. Yeah. Clear. Thank you.
So this is clear, the transfers. So de-recognize the investment property when you dispose it off, or if it is permanently withdrawn from use and no future economic benefits are going to be there. So if you notice here, there's an automatic indirect impairment happening here since we are measuring it at fair value at the end of each year. And if the fair value is reached such a level that it is no more economical to us, we can de-recognize it, or if it is disposed of by chance. Since we are measuring it at fair value, we do not need to worry about impairment testing. It is happening automatically at the end of each year. So we need to disclose the methods, assumptions, amounts included in P&L for rental income or any direct expenses for renting property, non-rented property, if there are any operating expenses, restrictions on realizability of this property, whether we can sell it or not, reconciliation between opening and closing carrying amount of investment property held at fair value, so that since we are required to remeasure it at the end of each year, and also credit or charge to P&L. Investment property that is not carried at fair value should be similarly subject to reconciliation separately from other properties. We'll show it as separate investment property, but it's done in the same manner as we'll disclose it for IAS 16 property plant and equipment. We'll disclose the depreciation methods used if you're using cost model, useful life, gross carrying amount, reconciliation, as well as, now this is something which we also missed in IndAS-40 investment property. We have only one model, cost model, but we have this disclosure as well. The fair value of investment property. So we are required to disclose the fair value of the investment property even though we are using cost model. This is all for IAS 40 investment property. If you have any doubts, please ask.